All right, everybody, I have an amazing video lined up for you today. I'm going to be covering probably one of the most misunderstood companies on the index. And at this point in time, it really has everything going for it. Prices are near all-time highs. The company has a rock solid, probably mid-yielding, sustainable dividend. It pays it on a monthly basis, and the company has outperformed the S&P 500 and the TSX over the last 1, 3, 5, 7, and 10-year timeframes. It is also a sneaky good under-the-radar play in terms of data center development, particularly in northern Canada. And the company, despite its big run-up in price, is still only worth, it only has a market cap of around $4 billion. So there is still plenty of size increase potential, I guess you could say, and that company is Exchange Income Corporation. They trade on the TSX under the ticker EIF.TO. This is another bull versus bear case video where I'm going to be going over the good things about the company, the bad things, and my overall thoughts. Now, the one thing about Exchange Income is this is a company I have covered over at Premium since 2020. And I think every single year I've covered it, people have either come to me, whether they're members, or I have read, whether they be analysts or pundits, that say that the company is overvalued. It has been like this pretty much every single year over the last 5 years, but they continue to do their thing. And the one reason I want to mention this is we are running our Black Friday promotion over at Stocktrades Premium. This is the cheapest prices on the year to get into the platform. We only do this once a year, and Black Friday is quite possibly our most popular discount we offer over at Premium just because the price is so cheap. So if you want that deal, I will drop it down in the description. We are not going to be running this for very long. We run it for a couple of days and then we shut it down. Last year we got over 100 members just on a single day Black Friday opportunity, and you can join over 2,000 plus premium members that are getting access to our model portfolios, the private Discord, the Q&A, all the stock research, the stock calls, the bull list, the foundational stocks, the stock screener. This is a custom screener that I developed. 5,400 plus equities, global equities that are ranked on 90 different metrics. So that stock screen will save you time. The research will give you the confidence you need to make better decisions. The model portfolios can, teach you how to potentially construct a portfolio that fits your risk tolerance. Overall, the platform is just an unreal resource for Canadians to learn how to invest and how to make better investment decisions. And the best thing of all is there is a 30-day subscription back guarantee attached to every single membership. So if you don't like it, you just send me an email and I will refund you every single penny, no questions asked. So again, that is in the description, but let's dive right into Exchange Income Corp. So what exactly does this company do? And this is probably why a lot of people actually shy away from Exchange Income Corp. It tends to have its hands in a lot of cookie jars, I guess you could say. And I've been overly critical about the broad nature of the business overall as well. But as I've come to know the company, it does have a lot of business elements and a lot of different types of businesses operating together, but they generally focus on one primary thing, one primary region. So what this company is, in a nutshell, like its core business operation, it is an airline company, but it is not an airline company like you'd think of an Air Canada or a WestJet. It's not in the business of getting travelers to their vacation destination. It is still operating passenger travel, yes, but it is more so a niche airline. So it is going to fly to very remote areas in northern Canada, and it is also going to operate medevacs and also cargo to those remote locations. I mean, even more recently, the company acquired Canadian North, which is a company that makes frequent trips to northern Canada, particularly, at least where I'm from, in Calgary. They do a lot of oil and gas where they are shipping or flying workers up to the job site and back. So they acquired this company recently, and they do make a lot of acquisitions, which I'll get to in a bit. The company also has another core business model, which would be manufacturing. So the company company produces a lot of machine components for the defense sector. It produces a lot of composite matting, and it even provides high-rise window washing. So this company does touch a lot of areas. However, a lot of those areas kind of blend into one core business model, and that is providing a lot of services to difficult areas to reach, niche regions, things like that. At this point in time, there's around 19 subsidiaries under this company's overall umbrella. It's pretty much kind of a small ball roll-up acquisition company that does a lot of things. I will admit it does a lot of things, but the only thing is, it has a very talented management team, and it does a lot of these things very well. So the first bull case I would argue is the diversity of the business model. If one area of the business is struggling, it might be offset by another. So we can think of an example of, let's say the oil and gas industry gets really rough. These oil and gas producers lay off a ton of employees, and ultimately Canadian North does not need to fly to those regions as much anymore. So this would no doubt impact Exchange Income Fund's, Canadian North segment, but it could be easily offset by, cargo flights to those regions, medevac segments to those regions, maybe a pickup in the window cleaning activity, composite matting for projects continues to excel, things like that. So the next bull case would be the acquisitions. Exchange Income Corp has done this for multiple decades now. It acquires companies, it merges them into the fold, and although, again, as I had mentioned, a lot of people might think of this company being too diverse, it generally stays in its lane. I mean, the acquisition of Canadian North, as I had mentioned, is just another added niche business to this company where it already operates, and it operates very well. I mean, we're talking about medevac and cargo flights to remote regions, passenger flights to remote regions, and now they just acquire Canadian North, which effectively merges into the fold with very little troubles. Whereas a company like Air Canada or WestJet, they're not really interested in providing small flights to Arctic regions. It's just not really in their wheelhouse, and an integration of something like Canadian North would be likely very difficult for them, which allows Exchange Income to also get these acquisitions on the cheap because there's very little competition for these companies. Staying in these niche type businesses has helped it immensely. And now probably the sneakiest bull case for this company, and that is artificial intelligence, data centers, and also grid expansion. So the company is mentioning it is seeing accelerated activity in its composite matting, so much so that it cannot even keep up with the pace of production. It has had to spend $60 million to open up a new facility in the United States. And these composite mats are very popular because they are utilized heavily in data center construction and grid expansion. And where exactly are a lot of these data centers being built or being proposed to be built? Well, we're talking about northern Canadian regions. We're looking at northern Alberta, northern Manitoba, and just other regions where, there's a lot of land to utilize and power is cheap. When we think of what Exchange Income Corp does, that composite matting, they do telecom infrastructure, kind of the construction of remote work sites, etc. There's a lot of potential there for the company in this regard, and that is actually what is fueling a lot of the results. I wouldn't be able to talk about Exchange Income Corp without talking about the dividend, and I am a total return investor. The only time I ever really speak about dividends on these videos is when they are actually contributing to a positive total return. And in the case of Exchange Income Corp, it definitely does. So the company's dividend growth is sporadic, primarily because it uses the bulk of it to fuel acquisitions. However, it is still a mid-yielding company. It used to be a higher yielding company back when the share price was a bit lower. Right now, it yields around 3.54%, I think. But the one benefit is it pays it on a monthly basis. I know people love monthly income, and you're going to get this with Exchange Income. There are not a lot of high quality monthly dividend payers out there anymore, but this is certainly one of them. So the bear case, and the first one to go over, is the fact that Exchange Income Corp's acquisitions have not been cheap from a total leverage, I guess you could say, against the company. So there's been a lot of debt accumulation and there's been a lot of share issuances. Now the company has done a very good job at making these acquisitions accretive. They expect Canadian North, for example, to be accretive by the end of 2026, meaning that although the company has diluted shares, it still ends up in an increase in overall earnings per share. This is definitely what you want to see when a company is issuing shares for an acquisition. But the company did get into a bit of debt trouble during the rising rate environment back in 2022, 2023. It kind of mitigated this in the fact that it locked in pretty much all of its floating rate debt at a relatively attractive rate. But if inflation picks back up and rates go higher, this does pose a risk to Exchange Income Fund, which is reasonably leveraged. Now, that's not to say that the leverage is not well covered. The balance sheet is solid. Interest coverage ratios are solid, but they could deteriorate if rates get worse. And this also makes acquisitions, which is the main avenue for this company's growth, a bit more difficult. So the second one, and probably the most obvious one, is operational complexity. There's absolutely no question that this company's business model is complex. I mean, you're running airlines, you're running manufacturing, metal manufacturing for the defense sector, drones for the defense sector, you're running high-rise window washing services, emergency medevacs, passenger travel to remote areas. And each particular industry comes with its own regulations, its own operational issues, its own, individual risks. So you need a very, very good management team to kind of cover this, be able to manage this. And they do have this right now, a long history of a very strong management team. But if that changed, this could pose a risk to the company because this is not an easy business to operate and not an easy business to keep tabs on overall. So some of Exchange Income's aviation business, like the passenger travel, the medevac, it is government subsidized, I guess you could say. For example, they have agreements and subsidies for indigenous healthcare up in those northern regions where Exchange Income Corp gets paid by the government to operate the services. Any sort of cuts to these types of services could have an impact on the business. And then finally, we're talking cyclicality. So a lot of Exchange Income Corp's services are essential. I mean, you could talk about the cargo shipments up to northern Canada. You could talk about the medevac services, the passenger travel to a certain extent. There could be a bit of cyclicality in there, but it is also exposed on the manufacturing end to a lot of cyclicality, especially, we're talking about the composite matting, all that type of stuff, the remote work sites. The construction industry would be, it's very heavily exposed to that. So if we see a slowdown there, we'd probably see a slowdown in results. And again, a very simple example would be that oil and gas industry. If that slows down, there could be potentially lower flights for Canadian North to those regions to drop workers off at the work sites. So something as simple as that can end up impacting results. And finally, valuation. So when I first added this company, it was ridiculously cheap. It was trading at only 10 times forward earnings. When I added it over to our bull list over at Stock Trades Premium, 10 times forward earnings. It was definitely a value play, especially, a high yielding, well covered dividend value play. It was a great opportunity. Now it's trading at around 21x expected earnings. There's definitely a lot of growth priced into this company right now. And it has moved from a value play to kind of a growth at a reasonable price play. I would not say this company is overly expensive, but I would not call it cheap either. The boat to probably get in on Exchange Income at a slam dunk value deal was probably 5 years ago, but the margin of safety is a little bit tighter now. I don't want to say it's gone, but it's just a little bit tighter. So what are my overall thoughts on this company? Obviously, I love this company. I've covered it for 5+ years now. It's still a stock we cover extensively over at Premium, and I don't have any plans of removing it from that list anytime soon. However, the business is complex, which is why a lot of people overlook it, which, I mean, to be fair, I generally overlooked this one when I first had a peek at it because it was just, I couldn't understand what this company did. But the more you dive into this company, the more you realize, yes, it provides a lot of services, different types of services, but it does so in probably one large region. And generally, when we think about it, it stays in its lane for the most part. It doesn't go too broad. Like you have to think, yes, it offers medevac and passenger travel to remote northern regions, and then it offers, remote worksite construction. But the thing is, it offers that construction in those remote regions. Like, I do think it stays in its lane for the most part, which makes it easier, not necessarily easy, but easier for that management team to operate this business. I think it is a fairly valued company right now with a very attractive dividend that a lot of people are going to love the monthly payout. And I do believe that the company has a lot more runway for growth in it. It grew revenue by 35% year over year last quarter. And I think the data center, the grid expansion is a sneaky element here for AI exposure for a company that absolutely nobody is looking at for AI exposure, and that's actually driving a lot of the results. Would I be a buyer here? Yes. Am I as enthusiastic as I was when the stock traded at under $40 a share? No, but I do still believe it is a high quality company trading at a reasonable valuation, and we've seen a lot of volatility in the markets over the last while here, but Exchange Income Corp just continues to make all-time highs. So that's it for the video, everybody. Hope you like it. Head down below, like the video, subscribe to the channel, comment, head down below to the description and grab that Stock Trades Premium opportunity we have right now for Black Friday. There's a couple days to get in on this offer, and if you miss it right now, you will not be able to get this level of pricing until next year with a 30-day subscription back guarantee. You got no risk to just hop on the platform, try it out. If you don't like it, drop me an email and I will refund every penny you've given us. And as always, everybody, stay tuned for more great investing content.